Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm joined by Michael O'Neill, Portfolio Manager at IML. He's going to be talking to us about the current state of Australian equity income and where the opportunities will lie in the years ahead. Welcome, Michael. Thanks for joining us. So let's start with the big picture. Broadly speaking, yield is very tough to find at the moment, as evidenced by the average yield on the ASX, and we'll put up a chart for the viewers to look at and what we're about to speak about. So what has led to this, and how are you navigating the current environment?
Well, Anna, the yield on the ASX in the last 3 years has fallen from about 5% to about 3.5% today. And there's two main culprits. The first is financials, the second is materials. Together they're about half the market. So you put it down to the concentration of the index more than anything. In the case of the financials, major bank stock prices are up and their earnings and dividends just haven't kept pace with the momentum in their share prices. CBA is now 12% of the index. And that being one part, I mean, prices not keeping pace with earnings on the financials, but also when it comes to the materials, iron ore prices have been hit pretty hard by falling demand for iron ore from China. So the materials yield as a whole has fallen from 8.5 to about 3.5 in that period. So given how big those sectors are, it really is hard to have seen growth in the index yield at all.
Yeah, okay. So at the same time, obviously, volatility has picked up at the start of the year. Is uncertainty impacting the companies that you look at and their ability to generate profits and pay dividends?
Short answer is no. Okay. So if you look at what's happened this year, certainly volatility kicked up in April with the Trump tariffs, and then we've also seen a lot of geopolitical tension more recently around Iran, Israel and the US. In April in particular, the market was off 15%. But at the same time, in all that noise and sentiment, share prices have now rallied back to their highs. Okay. So if anything, the concern now is a degree of complacency in terms of market valuations, which makes it vulnerable to such shocks. So we'd expect volatility to continue. But at the same time, the volatility in dividends is much lower than the volatility in share prices. Some of the companies we were buying in April when volatility kicked up are completely unaffected by these geopolitical issues. Stocks like Amcor, like the Lottery Corporation. These stocks, their earnings won't be impacted nearly as much. And so volatility can sometimes provide an opportunity for us to get set in these stocks and build a diversified portfolio of stocks with compounding earnings, growing yields. So, if you've got a diverse approach, you should feel confident that the income generation of your portfolio should be pretty steady.
Okay. So retirees or people about to retire typically rely very heavily on income, and sequencing risk is a key focus for them. How do you manage it? What are your strategies to protect capital without sacrificing income?
So our IML Equity Income Fund is directed at the needs of retirees. And it's true that if you sort of take the risk of poor investment returns at or near retirement and you add withdrawals to the equation because you actually have to live off your investments, it creates a recipe for a lot of risk. Mm-hmm. So the solution to that is higher income and lower risk. Mm-hmm. So really the way we do that is by buying stocks where we have confidence that they can sustain and grow their yields. They often have higher yields than market yields. Mm-hmm. And that provides a degree of diversification and lower risk. We add to that a diversification of income sources. So we generate income also through options, and that can be very lucrative when volatility kicks up. So you can achieve higher income, but with lower risk. Okay. So what it means when you're a retiree is, you're not in that sort of position of having to draw down your savings, impair your balance permanently. You've got a steadier base to work with. Your
research shows a stark difference in long-term outcomes between income-focused equity funds and passive ETFs for retirees. Can you unpack that for us, especially because on a surface level, total returns look similar from both?
Yep. So 40% is the difference that it can make. The scenario we looked at was taking a passive ASX 300 ETF and comparing that to an investment in the IML Equity Income Fund. So we looked at it since the inception of the Equity Income Fund in 2011. We used the ASFA tables for standards of retirement. And then we looked at the impact of making steady withdrawals according to those standards, which were indexed for inflation. Now, funnily enough, if you'd held those two investments as a saver, and you were able to reinvest distributions, the total returns would be about the same. They'd be about 8% for the entirety of that period. But if, on the other hand, you don't have the luxury of reinvesting distributions because you're reliant on your income to live, the volatility in the drawdowns at inopportune time can steadily erode your balance, and you end up with 40% less savings at the end of that period. So really our objective is to keep retirees invested.
So we'll get down to sector and stock level. Which sectors typically house the best sustainable income payers? And can you give me the thesis on 2 ASX names that you like right
Sure.
now?
Well, 2 sectors that are usually synonymous with income are infrastructure and property, the REITs sector. Now, don't get me wrong, we don't load up with infrastructure and REITs because you've got to be very selective, because you've got to watch out for high debt levels, high correlation to bond yields. And also there's a lot of cyclical stocks in the property sector with commercial property exposure to data centres. It is an area synonymous with income, but I'll point out my 2 favourite income stocks, Dalrymple Bay Infrastructure, DBI, and Charter Hall Retail REIT. Sorry, yeah, it's the 2 stocks pay over 6% yield. The yield is growing, and I challenge anyone to find me 2 other stocks with that sort of profile of growing yield and that level of certainty attached to it, so the security of the income being generated from it. In Dalrymple Bay's case, they own Dalrymple Bay Coal Terminal. They've got a lease until 2050 with a right to extend until the year 2100. Their levies are indexed with inflation. They don't take any volume risk, so it doesn't matter how much throughput goes through the port, they get paid the same. They're protected for force majeure, so weather events are happening more and more. That risk is not on them. And also they get to pass on any cost increases to their end users. So very secure income stream and growing. The other one, Charter Hall Retail REIT, CQR, they own a $4 billion portfolio of neighbourhood centres anchored by Woolies and Coles, very low vacancy rates, and getting turnover rent increases. They also own a portfolio of petrol stations, which have over 10-year weighted average leases, and they get inflation-linked increases in their income. So 2 great stocks. If I could add a third, it would
Absolutely.
be a new stock to come to market in the next months or so, EQIN, which is the listed ETF version of our IML income fund.
Okay, great. So equally, which parts of the market are you more likely to steer away from?
Yeah, so we're very bottom-up in our approach. We're very selective, so we don't take a top-down approach with sectors. I've called out the risks with infrastructure and property. You've got to be careful. But obviously, the banks and resources is an area where you've got to be particularly careful at the moment. Bank dividends have corrected from around about 5.5% to 3.8% across the 4 majors. There is further risk to the downside, probably for all but CBA. Bearing in mind CBA's yield is only 2.6% today. So I really wouldn't see any, I don't know what's going to make the yields of the banks more appealing in absence of a correction in markets. In the case of the resource stocks, the iron ore names have already seen cuts in their dividend yields from around 8 to sub 4%. We could see, not only have we seen pressure on Chinese demand, but we could also see a lot more pressure from supply, which is coming on in the next 4 years, hitting iron ore prices. There's over 200 million tonnes to come on in the next 4 years, largely, most of it from the Simandou project. So those would be the areas of caution.
At the top of the conversation, obviously, we talked about a challenging yield environment. So do you think this is just a moment in the cycle, or how do you think things might evolve over the next 3 to 5 years?
Well, if you look at the cash dividends paid by the index as a whole, it might not be a moment in the cycle because of those ongoing pressures to financials and materials, which make up half of our market. That being said, there's a lot of dispersion in valuation in the market at the moment. There's a lot of stocks with higher than market yields. And you could see a scenario where those other parts of the market start doing more of the heavy lifting. So these are the areas where we play in. Plenty of opportunities to generate above market yield and have confidence that you can rely on that yield. And if you've got options to use at your disposal, that further gives you confidence that you can give a smoother ride on income and on capital.
Okay, great. Thank you so much, Michael, for sharing your insights today, and looking forward to our next chat.
Thanks, Anna.
If you enjoyed that interview, make sure to give it a like, and don't forget to subscribe to our YouTube channel where we release new content every week.